Imagine paying a company to let you test out their mattress for like 8 hours.
Right.
And then, willingly buying it on your way out the door.
It's brilliant.
It is. I mean, that is the exact psychological trap that this one specific hotel chain has built. And it just drove a revenue spike that is, frankly, making traditional hospitality analysts' heads spin.
Oh, yeah. It completely inverts the whole customer acquisition model.
Yeah.
Because, in traditional e-commerce, you're bleeding capital on digital ads, right?
Like hoping for a click.
Exactly. Just hoping someone clicks, buys, and then, doesn't return the item. But here you have a captive audience.
Captive audience that is paying you.
Paying you for the privilege of experiencing your physical product in this perfectly curated environment.
Which brings us to the core of today's deep dive. We're looking at the Q2 2026 earnings call for Atour Lifestyle Holdings.
Ticker symbol AT8.
AT8, exactly. And we're putting our talk tickers lens on this because this transcript is just a fascinating case study in business model evolution.
It really is.
So the mission today for our retail investor listeners is we're going to extract the absolute essentials from these numbers. We'll look at the real story behind them, break down management's forward-looking guidance, and figure out, if this stock actually deserves a spot in your portfolio.
Yeah, let's get right into it because the headline numbers they're wild.
They are. So let's start there. Segment 1, the headline numbers. Give us the raw top and bottom line data.
Okay, so net revenues for the second quarter hit 3,490 million RMB.
Wow.
Which is a massive 41.4% increase year over year.
That's huge.
And net income came in at 548 million RMB. So that's up 29% year over year.
Okay, so top line and bottom line are just cruising.
And then if you look at adjusted EBITDA, that reached 821 million RMB.
Which is what, like 34%?
34.6% up, yeah.
Okay, let's just unpack this for a second because 41% top line growth, that's practically tech stock territory, right?
It is, yeah.
That is not what you usually expect from a hotel chain.
No, not at all.
Especially when you factor in the Chinese macro environment right now, which management themselves said is seeing a real divergence in consumer performance.
Right, people are tightening their belts.
Exactly. So I look at a number like that for a physical brick and mortar hospitality brand, and my immediate reaction is like, okay, where's the catch?
You're looking for the gimmick.
Right. Are they just building properties at warp speed to juice the revenue numbers? Like, is it just unsustainable physical expansion?
Well, so physical expansion is definitely a significant driver here, but the unit economics tell us it is not reckless.
Okay.
They did open 101 new hotels in Q2 alone.
Just in one quarter. That's more than one a day.
Yeah, over one a day. So that brings their total operational footprint to 2,175 hotels.
Okay.
Which is a 19.2% increase year over year.
That's a lot of real estate.
It is, but they also reported a pipeline of 811, what they call manachised hotels under development.
Okay, wait, let's pause on that word because manachised is crucial to understand here if we're looking at the stock.
Yeah, it's a portmanteau. Managed and franchised.
Right. So they aren't laying out massive capital to buy the land and build the buildings.
Exactly. They aren't holding the real estate risk.
They are managing the property. They're enforcing their strict brand standards, but they're franchising it out to partners who take on that capital expenditure.
Right. The franchisees take the real estate risk. Atour takes the management fee. So their manachised hotel revenue, which grew about 32.8% to 1,725 million RMB. That is high leverage, asset light income.
Okay, but hang on. If the core hotel operations grew by 32%, that still doesn't fully explain the 41.4% total revenue explosion.
It doesn't. And that gap, that missing percentage, that's where the thesis for this company completely changes. To understand that aggregate revenue spike, you have to look at what they are selling inside those rooms.
Okay, this is the story behind the numbers. Section 2.
Yeah. The retail segment revenue skyrocketed by 63.2% year over year.
63%.
Yeah, hitting 1,575 million RMB.
Okay, that number requires a pause. Just to put that in perspective for everyone listening. The core franchised hotel revenue was 1,725 million.
Mm-hmm.
The retail revenue was 1,575 million.
It's almost at parity.
The retail side is literally on the verge of eclipsing the hospitality side.
Yeah, it's wild.
This isn't a hotel with a cute little gift shop by the lobby anymore. This is an e-commerce lifestyle brand that just happens to use hotels as its primary customer acquisition funnel.
That's exactly the way to look at it. And the scale of that product penetration is just staggering. Management reported they have sold 12 million units of their Deep Sleep Memory Foam Pillow Pro series.
12 million pillows.
12 million.
That is absurd.
And it gets better. Their Comforter GMV, so gross merchandise volume, that jumped by 80% year over year.
Wow.
A huge part of that was driven by their summer launch. They dropped this Deep Sleep Thermoregulating Comforter Pro 3.0.
Thermoregulating, so it keeps you cool in the summer.
Exactly. And they are seeing aggressive uptake in adjacent categories too, like fitted sheets, loungewear, all that stuff.
The R&D specificity they mentioned on the call was fascinating to me. Like, they talked about the Deep Sleep Memory Foam Pillow Pro 4.0 having an upgraded dynamic support system for frequent position changes.
Right, for people who toss and turn.
Yeah. I mean, they aren't just slapping a hotel logo on a generic wholesale pillow.
No, not at all.
They are engineering products for a very specific use case, and they are locking the guest into this closed-loop ecosystem.
Yes.
You sleep on it, you love it, you open your Atour app on your phone, and you buy it before you even check out.
But that closed loop only functions if the supply chain operates with absolute precision.
Oh, for sure.
Management emphasized that they've established end-to-end quality control and set these new industry standards for manufacturing precision. Because think about the operational risk here.
Right, if you get a bad pillow delivered.
Exactly. If you have this phenomenal life-changing sleep experience in the hotel room, but then the comforter that gets shipped to your apartment is flat or poorly stitched or smells weird.
The brand equity is instantly destroyed.
Instantly. The physical product has to perfectly mirror the curated hospitality experience you had in the room.
Okay, let's pivot to that curated hospitality experience for a second.
Yeah.
Because the traditional hotel metrics are where this divergence we're talking about really shows up.
Yeah.
So their RevPAR, revenue per available room, remains solid at 345.4 RMB, which is about, what, 100.7% of where it was last year?
Yeah, essentially flat, but slightly up.
But I did notice in the transcript, their occupancy rate actually dipped slightly.
Yeah, it did.
It went from 76.4% in the same period last year down to 76.2%. Now, if I'm a traditional hospitality analyst, a drop in occupancy, even a small one, is usually a red flag. Is that a thesis breaker here?
I don't see it as a thesis breaker at all.
Why not?
Primarily because of how they are actively resegmenting their properties. CEO Wang Haijun explicitly stated on the call that homogenous products and services remain under pressure.
So the generic stuff is struggling.
Exactly. The market is ruthlessly punishing generic mid-tier hotels in China right now. So Atour's response is to aggressively push premiumization and highly differentiated experiences.
The Atour Origin brand is the perfect example of that.
Yes.
They are pulling in a RevPAR of over 450 RMB on those Origin properties.
Right. Well above the 345 average.
And they achieve that margin by hyper-curating the touch points.
Yeah.
Right? Like arriving to a wilderness-inspired signature scent in the lobby.
Oh, yeah. They have a dedicated chatting room for afternoon tea.
Yeah, and waking up to a breakfast featuring local Yunnan flavors. It's just an anti-commodity play. They're saying we aren't just a bed and a shower.
Right. It completely insulates them from the race to the bottom pricing wars we see in the generic hospitality sector.
It's because you can't price compare a wilderness scent and Yunnan breakfast with a generic Holiday Inn equivalent.
Exactly. And they're taking this even further upmarket. Their SAVHE brand, which is entirely focused on wellness.
Wait, how do you spell that?
SAVHE.
Got it.
It incorporates classes and tailored dining options, and that brand hit a RevPAR of over 1,000 RMB in the second quarter.
Over 1,000.
Yeah, it sets a new high-water mark for their upscale segment. They are proving that the consumer will gladly pay a steep premium, but only for an experience they literally can't get anywhere else.
And here's the genius part. Every time a guest stays at an Origin or a SAVHE property, they get pulled into the broader retail ecosystem.
Yep.
They mentioned they now have an army of 120 million registered individual members.
120 million.
That is a massive captive audience. I mean, think about customer acquisition cost for a normal DTC sleep brand. It's astronomical. But Atour is completely insulated from those traditional marketing costs because the hotel is the billboard.
And those 120 million members,
Yeah.
They are the foundation for management's forward-looking guidance, which is arguably the most critical part of this earnings transcript for anyone looking at the stock.
Okay, so let's move into section 3, the guidance. What are they projecting?
Based on the strong momentum they saw in the first half of the year, they actually raised their full-year retail revenue growth guidance to 40%.
40% for the full year. That's impressive.
And overall, full-year net revenue is expected to increase by 30%.
Okay, 40% retail growth and 30% overall top-line growth is phenomenal. But we need to address the friction point here, because there is always a catch.
There is.
Management said they expect a modest year-over-year decline in the group's full-year net profit margin.
Yeah.
So if revenues are absolutely exploding, why are profit margins shrinking? Is this the moment where taking on heavy supply chain logistics for all those pillows and comforters comes back to bite them?
It's a very natural reaction to view margin compression as a massive red flag. Any investor would see that and pause, but we have to break down the mechanics of the mix shift happening here.
Okay, explain the mix shift.
The core manachised operations, where they're collecting franchise fees for managing a property, is an inherently high-margin business. It's asset light. The cash drops almost directly to the bottom line because the franchisee is paying for the building upkeep.
Right. You're monetizing intellectual property and management systems. You're not paying for physical goods.
Exactly. However, selling physical goods like manufacturing memory foam, warehousing these big, bulky comforters, handling logistics, and crucially, potential reverse logistics for returns.
Oh yeah, returns are brutal for margins.
Right. That carries hard costs of goods sold. So as the retail business grows at 63% and becomes a much, much larger slice of the total revenue pie,
it naturally dilutes the aggregate margin profile of the entire company.
Precisely. It brings the blended average down.
Okay, so it's not that the hotel business is suddenly less profitable.
No.
And it's not that they are taking a loss on the pillows.
Not at all.
It's just simple math. If a lower margin business unit outgrows a higher margin business unit, the blended average margin of the parent company has to drop.
That is exactly it. And co-CFO Wu Jianfeng added another technical layer to this on the call. He noted that the group's effective tax rate is expected to rise compared to last year.
Oh, interesting. So just a pure tax headwind.
Yeah, which creates an additional drag on the net profit margin percentage. But investors really need to separate margin percentage from absolute cash flow.
Because you can't spend percentages, you spend dollars.
Exactly. A slightly compressed margin on a massively expanded revenue base yields significantly more actual profit dollars in the bank.
And the balance sheet really reflects that cash generation, right? They reported 3.9 billion RMB in cash and cash equivalents.
A very healthy cash position.
But more importantly for retail investors, they are actively deploying that capital. They completed $150 million in cumulative share repurchases through the end of Q2.
Yeah.
And management confirmed they are steadily implementing their existing dividend policy.
That capital allocation strategy is a massive signal. Executing a $150 million buyback while simultaneously navigating this structural margin transition, it tells you that management firmly believes the public markets are undervaluing their cash flow.
And their long-term growth trajectory. They're basically saying, we know our margins are going to blend down a bit, but we are making so much cash, we're going to buy our own stock.
Exactly. They are betting on themselves.
All right, let's pull all these threads together for the bottom line. This is the actionable part of the deep dive. We have an operator transforming from a hospitality company into a dominant sleep economy retail brand. They're growing the top line at 41%, but facing some expected margin compression. What is the ultimate takeaway for someone looking at holding or buying ATT? Give me the bull and bear signals.
Okay, the bull signal is completely driven by their widening moat. They have successfully diversified their revenue streams away from pure hospitality risk.
Which is huge.
It is. Because think about it, if a series of typhoons depress summer travel, which management actually noted occurred in early July of this year.
Oh, right. The weather impacts occupancy.
Yeah, but they are no longer entirely reliant on selling room nights to survive the quarter. They have 120 million loyal members continuously purchasing high-margin lifestyle products from their app. They own the sleep economy in a way traditional hotels simply do not.
The diversification is key. You're not just exposed to travel macro. But let me play devil's advocate. What is the bear warning here? What could go wrong?
The bear warning is entirely about execution and market perception. Investors must accept that the fundamental margin profile of this company is permanently changing.
Right.
You are buying a lower margin retail supply chain attached to an asset-light hotel chain. That hybrid model can easily spook traditional hospitality analysts who only know how to model RevPAR and occupancy.
It doesn't fit in their neat little spreadsheet.
Exactly. Furthermore, scaling a physical supply chain at 40% a year introduces massive execution risks.
Oh, absolutely.
If their quality control slips, if people start complaining about the comforters, the entire brand ecosystem is threatened. The hotel experience gets tainted by the retail failure.
So the actionable advice for someone holding or researching this stock is to fundamentally change your monitoring framework.
Yes.
Do not obsess over macro travel trends or, minor dips in occupancy rates.
Exactly. If occupancy dips 20 basis points, but retail revenue jumps 63%, the retail growth heavily outweighs the occupancy fluctuation. You need to track their e-commerce conversion rates. You need to monitor their new product launches like the loungewear and bedding categories and watch their supply chain efficiency metrics.
So you have to evaluate them as a retail lifestyle brand first and a hospitality operator second.
That is the paradigm shift. Treat the physical hotel footprint as a highly profitable customer acquisition channel for a retail empire.
It completely flips the traditional script.
It really does.
Which leaves me with this final thought for everyone listening to mull over on their own. We just saw a hotel chain successfully transform into a retail sleep brand by utilizing its real estate as effectively 24-hour immersive showrooms. If this closed-loop model is this effective, what happens when traditional retail giants realize they could reverse engineer it?
Oh, wow.
Right.
Sure.
What happens when a massive apparel brand or a consumer tech company decides to open their own hotels, simply to trap consumers inside their product ecosystem for a night? Imagine an Apple hotel or a Nike hotel.
It radically redefines what a storefront can be.
It really does. Next time you check in anywhere, look at the amenities and ask yourself, are you just the guest or are you the top of the funnel?